Although it's important to be able to spot new trends, it is equally important to be able to identify where a trend ends. Getting out at the right time isn't difficult, but it does require some close observation of price action and looking for clues that might predict a reversal or a trend change. When trading Forex or the stock market, it's easy to find trades that match your technical criteria, but taking a timely exit requires great skill. One indicator that can help you to identify where a trend might be ending is the Parabolic SAR. So, in this video, we'll talk about the Parabolic SAR, you'll learn how to correctly trade with it, and I'll show you how to use it along with Ichimoku Cloud in a trading strategy. Before we continue, if you are new to my channel, make sure you subscribe, turn on the notifications and leave us a like to show your support. Parabolic SAR is an indicator displayed as a series of dots, mainly used to identify the market direction and the beginning of reversals. It allows traders to evaluate the trend direction, to pinpoint entry and exit points, and also placing trailing stops. The dots of this indicator shift from being below the candles during the uptrend to above the candles when the trend reverses into a downtrend. When the price is trading below the Parabolic SAR, this can be explained as a signal to sell or remain short. On the other hand, if the price is trading above the Parabolic SAR, this can be explained as a signal to buy or remain long. If you prefer price action, what you need to know is that during strong trends, the gap between the price and the dots widens. However, if the market is flat or choppy, the dots and price interact with one another quite frequently. Calculating the Parabolic SAR indicator is rather complex, and I don't want to bore you with it. What you need to know is that the SAR comes with two values, which can be adjusted depending on your preference. Step and maximum step are the values offered by the Parabolic SAR, and they determine how sensitive the indicator is to changes in price movements. The default settings of the SAR are 0.02 for the step and 0.2 for the maximum step. Once the price makes a new high or low, the acceleration factor increases by 0.02. This explains the reason why the gaps between the Parabolic SAR and the price increase during strong trends. By increasing the values of the step and maximum step, you can increase the sensitivity of the indicator, but at the same time sacrificing its precision, because the Parabolic SAR will offer many false signals. By lowering the values of the step and maximum step, the Parabolic SAR will become less sensitive, but will also provide more accurate signals from my experience. It's important to find a balance between these two values in order to generate quality signals which are not lagging the price. Speaking about lag, Parabolic SAR is indeed a lagging indicator because it follows the price, and you will need the help of other trading tools to generate quality signals. Now, how do you trade with Parabolic SAR? Well, this indicator provides decent signals that the market trend is about to change. Here's how it works. A dot appears below the price when the trend is upward, and a dot is placed above the price when the trend is downward. The Parabolic SAR trails the price until the trend has finished and begins to reverse. As the trend comes to an end, the Parabolic SAR moves closer to the price and ends up touching the price, then forms a dot on the other side of the price, signaling a change in direction. This is probably the easiest indicator to interpret because it assumes that the price is either going up or down. With that said, this tool is best used in markets that are trending and that have long rallies and small corrections. However, you don't want to use this indicator in a choppy market where the price movement is sideways. That's why it's better to use it as an exit indicator. The Parabolic SAR provides decent exit points as it provides a stop loss level that moves closer to the price regardless of the market direction. The rule is that you should close buy positions when the price moves below the SAR and close sell positions when the price moves above the SAR. So from my experience, it's better to use the Parabolic SAR to help you determine whether you should close your trade or not. But if you insist of taking your entries based on the Parabolic SAR, here is how I would do it. First, I would use it on higher time frames, and here's why. Trading the Parabolic SAR on a lower time frame will allow you to find a lot of trades every day. Everything is faster with a lot of noise. If your analysis isn't on point, the SAR might offer contradicting signals in a span of a few hours or minutes. On higher time frames, your trade will move slowly. This will avoid you to get too emotional and jump in a trade that is not ready. Many traders get into trouble trading the Parabolic SAR on lower time frames because they start watching this noise and they think they see a signal, which in fact is nothing more than noise. This can all be avoided by sticking the SAR indicator to the 4-hour or on the daily time frame or above. But you cannot trade with the Parabolic SAR alone. I would even say it's almost impossible to stay consistent trading just on the basis of the Parabolic SAR. That's why I would add the Ichimoku Cloud in the setup. If you don't know what Ichimoku is, make sure you watch this video on my channel. It will teach you the basics of using it. Now, the advantage of using Ichimoku is the fact that it offers a unique perspective of support and resistance. The most important tool of Ichimoku indicator is the Kumo Cloud, and this is all we need for our setup. So we have the Kumo Cloud as dynamic area of support and resistance, and the Parabolic SAR for entries and exits. We also pay attention to price action for obvious patterns, static support and resistance levels, and breakouts. Here's the setup for long opportunities. We want the price to be above the Kumo Cloud, and a dot must be formed below the price. For short opportunities, the price must be below the Kumo Cloud, and the dot must be above the price. Very important, you never take trades inside the cloud. So here is the EUR/JPY on a 4-hour chart, tracking the price action in the past 3 or 4 months. Here is our first short opportunity, as the price is below the cloud and a dot appeared above the price. We then had another short here, which was most likely a losing trade depending on the stop loss level. And then we had a great short here and another sell position here. Observe how the Parabolic SAR was well separated from the price, indicating a strong trend. We had another short here, which brought a small profit or a break-even trade, and a losing trade here, as the price entered the cloud. So during this period, we recorded 5 or 6 profitable trades and 2 losing ones. So don't expect 10 winning trades out of 10. Let's continue with our analysis. The price didn't manage to break through the cloud and resumed its downtrend. And here was a great short trade, which brought nice profits, followed by another winning trade here. Then we had another short signal, which was a losing trade or a break-even one, depending on the risk management adopted. Here we have our first buy order in 3 months. The downward trend was too strong and the price retraced back below the cloud. We had another short opportunity here, and currently we are also in a short setup. Let's take an example on the stock market. Here's Tesla on a 4-hour chart, following the evolution of the price since January 2019. The first short here, the second one here, which was a losing trade, another short opportunity here, which was a great trade, another decent trade here. Here was another tricky trade. The market opened with a large gap down, and I personally wouldn't be comfortable pulling the trigger at that point. But if you followed the system and took the trade after the gap, this was a losing trade. But no worries, because we had other opportunities to short the market here And here, the last trade in particular is the perfect trade, with the price slowly going down with small corrections. And now we are in a possible buy mode because the price is above the cloud. We just have to wait for a dot to be formed below the price. Keep in mind that these signals occurred in the past 6 months because we trade the higher time frames. So you just have to be patient and wait for the right moment, and don't be discouraged if you get 1 or 2 losing trades in a row. Of course, try to trade when you see a clear trend and avoid markets that are ranging or with low volatility. Now, if you got value from this video and learned something new, make sure you subscribe, turn on the notifications so you don't miss future uploads, and leave us a like to show your support. Until next time.